In this video, we're going to go over Amazon stock after their full financial year of 2020. The data in this video comes directly from their 2020 annual report on Form 10-K. Make sure you watch until the end to get our proprietary intrinsic value range. I think the range we come up with at the end is really interesting for this company. If you enjoy this video, please don't forget to like, subscribe, and even hit the bell to get notifications sent to you whenever I upload a new video so you can get this information in a timely manner. When it comes to investing, timely information can be critical. Business and segments. As for business, Pepsi has 7 reportable segments. FLNA, which is Frito-Lay North America. When Pepsi references North America, they're basically just doing US and Canada, and they're leaving out Mexico. They also have Quaker Foods North America, which is QFNA, which includes their cereal, oatmeal, etc. And you have Pepsi North America, which is their beverage business in US and Canada. Now for the rest, they're just basically geographic regions, and they include all their products. So Quaker, Frito-Lay, their beverages, and these are Latin America, Europe, Africa, Middle East, and South Asia, and Asia Pacific, Australia, New England, and China, or APAC. And when I analyzed what percentage of total revenue these segments come up with, the top 3 were Pepsi Beverage North America, Frito-Lay US and Canada, and Europe. And those were 32, 25, and 17% respectively. One thing we always do is look at the auditor's report to make sure the auditors didn't find anything suspicious. And in this case, we got an unqualified opinion on financial statements and an unqualified opinion on internal control. And these are the best opinions you can get on both parts of the audit report, so we are assuming this is reliable information. Okay, financial health. The current ratio could be better, but it is still pretty close to 1. However, this company has a lot of inventory, so the quick ratio subtracts inventory out of the numerator. So the quick ratio comes all the way down to 0.81. And this is even more of a liquid measurement, but that's this company's business model, so we're going to have to accept that. Something that alerted me was the goodwills and intangibles make up almost half of their total assets. But then again, I remembered that one of the most valuable things to Pepsi and their competitor Coca-Cola is their brand name. So you can't really, that's not a physical asset, but I think anyone would agree that that is valuable. Next, their total debt to equity ratio is extremely high at 325.78%. This is due to them issuing a lot of debt this past year. Then they also have a negative tangible book value, which makes sense because their total assets are mainly intangible or almost half intangible. However, you do have a positive free cash flow 3-year average. Up until this year, they're going to have more interest expense next year, but up until now, they've been making plenty of cash to pay their interest. Operating cash flow over interest expense is at a 9.41 times, and EBIT over interest expense is 8.94. So they're making plenty of money to pay their interest, but hopefully they can keep that cash flow up. We gave them a 5 for competitive advantage. For positives that bring it up to a 5, they're a large company. They have that intangible value. They have power over suppliers. They can negotiate lower cost, giving them economies of scale on all costs because they can buy in bulk. They also have somewhat diversified segments, but also all related to the food and beverage industry. So they have some economies of scope there that they can use some advantages they have in food with beverages and vice versa. However, what brings it down from a 10 is that concentrated market with competition from a behemoth of a company, Coca-Cola. And they do have really high debt. I wasn't actually sure if to make that a positive or a negative due to the low interest rates and the tax deduction, but either way, it has recently increased a lot, so I'm not sure yet. And then you have the negative tangible book value, which will scare any value investor away. That negative tangible book value lets you know that if this company does go bankrupt by not paying its debt, that you would most likely not get a penny for the assets being sold in the liquidation. Growth rates of the past 3 years. The top 3 were free cash flow available to equity investors, operating cash flow, and gross revenue. The FCFE is inflated due to issuing a lot of debt recently. Like I said, this might not necessarily be a bad thing due to low interest rates, and it's definitely not a bad thing as long as they can keep their cash flow high enough to pay the interest expense. For the 3 lowest, the negative net income is a little alarming, but for a mature company, that positive operating cash flow is more important in my opinion for a company as mature as Pepsi. Here's the intrinsic value using a 12% discount rate for all of the income metrics that we measure for. using those metrics as base rates and the 3-year CAGRs. So you see the lowest come in at $12 for net income, and then the highest you have $598 for revenue. Now, this is intuitively what you would expect. You don't always see revenue being top and net income being the bottom, EBITDA being about the middle, and then gross revenue being right below revenue, but you do in this case. One thing I did notice is none of these metrics that investors commonly use to value a company come even close to $140, which is the current market price for Pepsi. It goes from $102 to operating cash flow to $333 to gross revenue. And I honestly don't know anyone that uses gross revenue or revenue to value a company because there's so many more expenses after those metrics. Okay, here is our range of intrinsic values. We chose free cash flow because that's such a good metric when it comes to actual cash generating ability to the firm, even though we do believe that free cash flow available to equity investors is even better. But it's really inflated this year because it just so happens that Pepsi did issue a lot of debt. So we want to stay far away from that 194%. And we looked at the average of all the other growth rates and the median, and we kind of decided on 10%. Pessimistic is pretty aggressive in my opinion at 1%. But with Pepsi being so mature and having that positive free cash flow and possibly could really take advantage of this debt they just took on, I think I didn't want to go negative for pessimistic, so I feel comfortable with that. And this created a range of $43.42 per share to $94.03 per share. The closer you can get to $43, the less risk and higher gains you are expected to receive, and vice versa for $94. To sum this up, with the market price currently at around $140, I would recommend sell on this big time. The soft drink industry is going down, and possible future risk of sugar tax, which I know is already in effect in some cities, Philadelphia being one, it had drastically decreased soft drink consumption, and not to mention the firm is just simply highly valued in our opinion for whatever reason. So that is our summary on Pepsi. Thank you for watching till the end. If you enjoyed the video, please like, subscribe, and even share with your friends interested in investing. If you agree or disagree with my calculations and estimates, please let me know in the comments. Also, if you have any more recommendations for stocks you would like me to value, please include that in the comments as well. Thank you for watching, and go have fun investing.